Welcome to The Explainer. Today, we're jumping right in to decode a really fascinating trading strategy, one that tries to profit from market chaos without you having to guess which way things are going to go. We're talking about the delta neutral strategy.
So here's how we're going to tackle this, using a real-world trading example. First, we'll get the core idea down. Then, we'll see how to actually build the trade, how to put the hedging on autopilot, how to manage it as it grows, and finally, we'll look at the actual results.
Okay, first things first. The whole game here is about trading volatility, not direction. And to really get this, you kind of have to rewire your brain a little bit to stop trying to predict if the price is going up or down.
And that really is the million-dollar question, isn't it? This is what delta neutral trading is all about. It's for traders who believe they can make money based on how much the market moves, not where it moves.
So, here's the secret sauce. You build a position where your initial sensitivity to small price changes, what traders call your delta, is basically zero. By taking that directional bet off the table, you're free to profit from other things, like a big swing in volatility, or even just the steady decay of time as you collect that option premium.
All right, so theory's great, but how do you actually build one of these things? Let's walk through the practical setup, step by step, using the exact trades from our source material.
The classic way to start is with what's known as a short strangle. You're basically making two bets at once. You sell a call option, betting the price won't shoot up past a certain point, and you sell a put option, betting it won't crash down past another point. Since the delta of the call and put are opposites, they pretty much cancel each other out right at the start.
And what's really cool is this slide shows the very first trade from the experiment we're following. You can see the trader sold a call with a strike price of $36,000 and a put at $33,500. Right off the bat, they collected 0.0023 Bitcoin in premium. And look at that total delta. It's pretty much zero, just like we wanted.
Okay, so you've set up your position. It's perfectly neutral. But the market moves, right? Your delta isn't going to stay at zero for long. So how do you handle that? Well, this is where the autopilot comes in.
See, the trader in our source isn't sitting there, glued to the screen, hitting buttons all day. No way. They're using a specialized tool that automates the whole hedging process. They tell it, hey, my target delta is zero. If it ever strays past this super tight limit, I want you to automatically trade some Bitcoin futures to bring it right back to neutral.
And this slide is a perfect example of that autopilot in action. So, early on, Bitcoin's price starts to fall. That causes the portfolio's delta to creep up into positive territory. The second it crosses that plus 0.01 threshold, bam, the tool instantly sells futures to create an opposing negative delta. The whole thing is brought back to neutral. And this is all happening automatically, 24/7, without a human lifting a finger.
Now, as great as that sounds, this strategy is definitely not set it and forget it. As you start adding more and more options positions, you have to be really smart about how you manage that automated hedge.
And that brings up a really important question. See, as your portfolio gets bigger, its sensitivity to price changes, what traders call gamma, gets bigger too. And if you keep your hedging limits super tight, that autopilot is going to be trading like crazy, racking up fees with every little market hiccup. The key is you have to adapt.
And here, you can see exactly how the trader adapted. As they layered on more short strangles, that gamma risk shot up. Even tiny price wiggles were causing big delta swings. So to stop getting whipsawed by constant, expensive little hedging trades, they did something smart. They widened the autopilot's limits, going from a very strict plus or minus 0.01 all the way up to 0.04. It's like telling the system, hey, don't sweat the small stuff, which is absolutely crucial for keeping your costs down as you scale up.
Another big decision you have to make is what you use to hedge. On one hand, you have perpetual futures. They're super liquid, which is great, but you can get hit with high funding fees. On the other hand, you have dated futures. No funding fees there, but they might be less liquid and trade at a premium. The trader in our source actually used both, shuffling parts of the hedge between them to keep costs as low as possible.
So, after 6 weeks of selling options, managing gamma, and letting this autopilot do its thing, what was the bottom line? Let's get to the results. I think this quote from the source just says it all, really. Hedging isn't some magic trick for guaranteed profits. It's a powerful tool for managing your risk and, more importantly, for changing the kind of risk you're taking on.
Okay, check this out. Over the 6 weeks of the experiment, Bitcoin rallied about 25% and had some wild swings. That's usually a recipe for disaster for a short strangle, and yet the final portfolio ended with a 1.6% profit. Now that's not a life-changing gain, but just think about the crazy market they went through. Finishing in the green at all is a huge win for the hedge.
But to really get it, you have to ask, what would have happened without the hedge? The data shows it clear as day. The moment the Bitcoin price blew past the strike of that first short call, an unhedged, naked position would have been crushed. A huge, immediate, painful loss.
But the hedge portfolio tells a completely different story. And this is the whole point. As that short call was losing money hand over fist, the futures hedge was making money. The two canceled each other out, shielding the portfolio from that catastrophic drop and creating a much, much smoother ride. The hedge did its job perfectly.
So, when you get right down to it, this strategy isn't about getting rid of risk, it's about swapping one kind of risk for another. You're trading the risk of being wrong about direction for the risk of being wrong about volatility. Which really leaves us with one final thought to chew on. Are you sure you're trading the risk you think you are? That's all for this explainer. Thanks for joining us.